any company that has articulated a strategy to make money from the on-chain economy, whether that's as a dealer of digital assets like Coinbase or Bullish, who just came to market, but also whether they're a provider of infrastructure into the space.
Investment banks are shifting their weight into crypto equities in ways that would have been unthinkable just a few years ago. If you look at the league tables in 2025, Cantor Fitzgerald has actually conducted more investment banking business than Goldman Sachs year to date, largely because of their willingness to underwrite crypto-related companies. Now firms like Cantor Fitzgerald and BTIG are outpacing them by leaning into digital assets. BTIG, in fact, has done more business than Morgan Stanley. Again, a seismic shift in market dynamics.
The investment banks are really putting a lot of weight behind bringing equities to market. And you can see that in just the league tables, where year to date, Cantor Fitzgerald has done more investment banking business than Goldman Sachs. Let that sink in, because they've been on the forefront of banking crypto equities. BTIG has done more business than Morgan Stanley. This is really big changes in the market share. And now there's a rush, essentially, by the investment banks to get involved, and they're willing to underwrite not only the kind of digital asset treasury companies like the one that you are forming, but also anything peripheral to the space. And the banks being willing to hold that paper for 24 hours in the case of an IPO, or maybe for months in the case of one of these pipes or SPACs, is a real vote of confidence to the traditional capital market participants on Wall Street. So we think that's durable, and we think that it's going to be a very wide number of beneficiaries. So we've been running crypto equity strategies for almost 5 years now. And what we noticed is that they are really, really volatile. And the tendency is that at the top of the market, the ones with the most leverage are going up the most and doing the best. Leverage is toxic to Bitcoin, as we learned over the last few cycles. And what that dynamic does is that basically at the top of the market, your crypto equity indices are full of the most leveraged stuff. So when there's a washout, like, they're overweight that high leverage, and the drawdowns have been considerable, and the since inception performance of a lot of the crypto equity products have been subpar from my perspective as someone who wants to put a meaningful amount of my own money in products that are Bitcoin aligned. So what we aim to do with on-chain economy ETF, and thanks for calling out the performance. I just want to be clear that I think those numbers are correct through August 14th or something yesterday, and but the past is no guarantee of the future, and we're trying our best to manage this portfolio according to this guidelines, but we might be wrong, we might be lied to, you never know. So investing is risky, so not financial advice. But what we're trying to do is take a very wide approach to the space. Any company that has articulated a strategy to make money from the on-chain economy, whether that's as a dealer of digital assets like Coinbase or Bullish, who just came to market, but also whether they're a provider of infrastructure into the space. And given Bitcoin dominance still here up around 65%, some of the biggest infrastructure providers are selling electricity, electrical equipment, other kind of industrial infrastructure. And it's becoming meaningful to the EPS growth. We think it's becoming meaningful to the multiple. They're increasingly calling out the tailwind from Bitcoin mining. I'm referring to that kind of energy and utilities slug. But then you also have this whole class of kind of what I'd call fintech e-commerce names that overlap with some of the Mag 7 in the US, but they're focused on LATAM, or they're focused in Asia. And some of those companies are starting to adopt stable coins, significantly, and calling it out as cost savings. So anyway, the big picture here is that our investment universe is vast. It's over 150 names that are have articulated a strategy in digital assets. And we're targeting this barbell approach where, yes, we have some of the pure plays. It's roughly a third of the fund is in kind of that pure play crypto equity space. We have the peripherals bucket where we're into that e-commerce, fintech. And then we have the low volatility bucket, which is this kind of utilities, energy, infrastructure component. And that provides a lot of ballast. I'm trying to compound, avoid big drawdowns by being very diversified. I feel like when Bitcoin's, up here near all-time high, being diversified is a good thing. Kind of the rising tide lift all boats. You might not catch the next 10 bagger, but maybe that was really the trade a year ago, to look for 10 baggers. And then as we have drawdowns, we'll be able to kind of jettison some of that low vol ballast and turn up the dial on the volatility. So I think what I'm most pleased by is that the outperformance versus Bitcoin since inception has come with lower volatility. So twice the performance at lower volatility. For me, that's a sweet spot. There's no guarantee we can duplicate that, but that's what we're aiming to do.
Wall Street underwriting IPOs, global utilities integrating Bitcoin mining, and fintech companies leveraging stablecoins, the on-chain economy has become vast, diverse, and durable. But he's also cautioning investors not to be seduced by leverage or concentration risk. Instead, he proposes a diversified, risk-managed approach that balances pure plays, peripheral adopters, and low volatility industrial anchors.
They won't even go into our universe unless they've called out Bitcoin, blockchain, crypto as some potential driver of their business. And then we're aiming for a certain volatility level compared to Bitcoin, compared to the S&P 500. And that's how we manage the portfolio construction. So yeah, that whole supply chain, you have companies that are selling industrial equipment into the data center industry. A company like Solaris, SEI, which is an energy company, but they make essentially these generators that are very helpful to co-locate next to a data center when you say want to use it for a mix of Bitcoin mining and AI. So that kind of dual purpose use requires some extra capex to repurpose. And as we've seen, many of the Bitcoin miners are currently pivoting away from being pure play Bitcoin miners to allocate some percentage of their capacity into the AI. So they need equipment to upgrade their data centers to be able to serve that market. We're looking in that space as well. Yeah, so our bias is to own companies because we're bullish on the space, and the more diversified approach we think is going to provide maybe a more pleasant volatility profile for investors. But we do have, a few screens to help us determine position sizing. And one of them is simply the leverage that the business has compared to its earnings power. And so names like a MicroStrategy, which in a pure play crypto equity index might be 10%, we're down at 3% or less than 3%.
Why?
It's leverage, and the way that these markets work, they're super reflexive. The indexes get overweight the most leverage names at the top of the market, and that's where your biggest risks can materialize. So, we saw it last cycle with all the tech companies that went bankrupt when they turned into Bitcoin banks, essentially. I think this cycle is going to be different because there's a bit more professionalism around how the leverage is being generated. But with a bearer asset like Bitcoin, I still believe that it's a volatile asset, more volatile than stocks. And I want to be in the business of compounding, minimizing drawdowns. And one way to do that is to look for strong balance sheets. It's kind of like the investing 101 from how I think about compounding. There had been stories in the last couple of years that TEPCO made an investment in a company that's mining Bitcoin, this company Agile X. It's really hard to get information from them about it. There's not too much in the media, but that story's out there. And then I saw that EDF, the French nuclear giant, they've also started to do a little bit of Bitcoin mining. Marathon just bought their data center business, 3/4 of it last week. And there's a new proposal in the French parliament to formalize those Bitcoin mining efforts, right? It can be a way to pay down the debt. They've got all this spare electricity that they used to export to Germany. Japan also has some folks of parliament who are talking about amping up the Bitcoin mining. And then the nuclear restart story is starting to heat up in Japan. And I looked at this stock that used to be $30 billion market cap. It's at $6. There's no analyst coverage. They're turning on their nukes. They still don't pay a dividend, right? So there's a lot of risk here. But it looked really cheap. And so combined with the heightened acceptance in France, that whiff of like, maybe we're going to do this. I thought, if that comes to Japan, that could be a big deal for TEPCO, but even without it, the risk reward is really attractive. So, we tweeted at the company to try to get them to talk a little bit more about their Bitcoin mining. I think that would help the multiple a lot, but there's a fundamental story there. There is some Bitcoin integration. If it got bigger, the stock could really rocket. So that's an example where we have some utilities and energy expertise in-house. We have a natural resources strategies. We've got an analyst. All he does is utilities. So he and I talk a lot about, which ones make sense. And we collaborated on that one. So far, it's been working.
Matthew Siegel's expert vision on how crypto equities are reshaping Wall Street, integrating into global infrastructure, and creating a vast new playing field for investors. The takeaway is clear. Bitcoin is no longer just a digital currency. It's becoming a driver of industrial demand, financial innovation, and global investment strategies. But to capture that opportunity, investors need discipline, diversification, and risk management.